I'm Samantha Daniels, and I would like to welcome you to our webinar on the Charity SORP 2026 changes. The charity not-for-profit sector is a specialised area which can be quite complex. The Shaw Gibbs sector group aims to ensure that we remain experts in this sector and to assist our clients uphold strong governance and to remain compliant with financial reporting. Regulatory updates, of which this is one, help us achieve this. So today's session is designed to help you understand what's changing, what the changes mean for your organisation, and the practical steps you can take to stay compliant. I'm delighted to be joined by Steve Meredith and Brian Clifford. We're all partners at Shaw Gibbs and we're all members of the charity sector group. In fact, Steve heads up the group. Between us, we have more years' experience than any of us would like to admit. We specialise in working with charities and not-for-profit organisations and bring extensive experience advising the sector on accounting, reporting and regulatory matters. We'll be sharing our insights and some practical guidance throughout this session. Before we begin, just a quick note to let you know that today's webinar is being recorded and we'll be sharing a copy of the recording with you afterwards. If you have any questions during the session, please submit them on the Q&A section and we'll aim to cover as many of these as we can at the end. The major changes from the charity SORP relate to leasing and revenue recognition. And for these, I'm going to hand over to Steve and Brian later on, and they'll give some more detailed explanations. So I'm going to lead you in very gently and we're going to have an overview of the other changes in the SORP. So the first thing to point out is that there are two separate changes and the effective dates for these differ. There are legislative changes which determine whether or not a charity requires an audit or an independent examination, or whether it can prepare receipts and payments accounts. These thresholds are set by charity law and are effective for financial years ending on or after 30th of September 2026. Thresholds for an audit are increasing from 1 million gross income to 1.5 million gross income, or 250,000 gross income and 3.26 million gross assets, up to 500,000 gross income and 5 million gross assets. In addition, an independent examination is now required for charities with a gross income of over 40k, and this was previously 25,000. A qualified examiner will be required where the income is greater than 500,000, and that was previously 250,000. Unincorporated charities with incomes of up to 500,000 are permitted to prepare receipts and payments accounts. The total for this was previously 250,000. In our experience, all but very small charities have not opted to prepare receipts and payments accounts, even though they were entitled to do so. This may be worth considering in future, as charities preparing receipts and payments accounts do not have to comply with the requirements of the SORP. Remember that you have to be an unincorporated in order to take advantage of this. Now, when Steve and Brian present their requirements relating to leases and revenue recognition, you may consider that reverting to receipts and payments account is a preferable option, as it will mean that you do not have to comply with these new requirements. However, you need to consider all of the consequences of converting to receipts and payments and not base your decision solely on avoiding the changes relating to these two items. But it's certainly going to be worth those size charities thinking about it. So moving on to the SORP 2026 changes. The SORP sets out how a charity preparing accruals accounts should apply accounting standards. The 2026 SORP changes are effective for accounting periods beginning on or after the 1st of January 2026. So, for example, charities with year ends 30th of September, 31 October, they're going to be preparing accounts under the old SORP, but they will be subject to the new thresholds. The SORP 2026 introduces a new three-tier system for reporting requirements. As you can see from the slide, these are based on gross income of 500,000, gross income up to 15 million, and then gross income over 15 million for tier 3. The tier that your charity falls into will determine the level of disclosure. One of the things that's affected by the tiers is the trustees report. In fact, trustees report has changed for all of the tiers. So tier 1 charities must comply with the requirements for tier 1, obviously. Tier 2 charities must comply with the requirements of both tier 1 and tier 2. And as you'd expect, tier 3 are going to have to comply with their own requirements, plus those of the earlier two. So all charities, including tier 1, are going to have to include things such as charitable purposes, details of charitable activities, how the charity provides a public benefit, and it must continue to include the statement that it has had regard to the Charity Commission guidance on public benefit. It must include an explanation to help the user understand the scale and nature of the activities undertaken by different volunteer roles. It should also explain the activities, projects, and services identified in the accompanying accounts. The SORP has strengthened the requirement relating to reserves as well, expecting charities to explain why reserves are held, how the target reserve has been determined, how actual reserves compare with the target, and any plans that they have where the actual reserves differ materially from the target. In addition to this, charities, tier 2 charities will need to expand on these details a little bit. So, for example, the role of volunteers, tier 2 will need to include that, but it's also going to need to put in things like the number of volunteers and the activities that the volunteer support helps to provide. It also has its own requirements. So in addition to expanding on those tier 1 subjects, it's going to have to include how well the charity has carried out its activities and the extent to which it's achieved its aims and objectives. If it has material investments, it's also going to need to include investment objectives and performance. Then we move on to tier 3 charities, which again are going to have to include all of the previous ones. And it will also have to include reporting on management of environmental and governance and social matters. It's the only charity that's going to have to, the only size of charity that's going to have to include those matters. It's also going to have to include performance of material fundraising and material expenditure incurred in raising income. As the slide mentions, the trustees report is your opportunity to show what the charity is doing and how it's benefited not only its beneficiaries but also the wider community. I think the SORP is trying to encourage the trustees report to show the impact that charity is having. Okay, so that's the bit on the trustees report. So there are a few other changes as well. You'll remember under the old SORP, if you had an income, charities with an income of over £500,000 were required to prepare a cash flow statement. This requirement is now included for tier 3 charities only. So you'd expect only charities with an income of over 15 million would need to prepare a cash flow statement. However, the SORP does also say that they must also qualify as a small entity under FRS 102 in order to be exempt from this requirement. So a charity will need to consider whether it satisfies 2 of the 3 criteria set out in FRS 102, that being the 15 million income, balance sheet total of 7.5 million, and employees of 50 or less. So if income is less than 15 million, a charity will qualify as tier 2, but if its balance sheet exceeds 7.5 million and it has more than 50 employees for 2 years in a row, then it's still going to have to prepare a cash flow statement, as it would not qualify as a small entity under FRS 102. Related party disclosures. Now, these have been clarified and expanded, particularly around key management, trustees, close family members, and transactions with connected parties. The core requirements are unchanged. They continue to be based on FRS 102. But what the SORP has done, it's redrafted it to make it easier to identify the required disclosures and to align with the new 3-tier reporting. Social investment, a smaller one really, but it's been simplified rather than fundamentally changed. So the principal changes are the alignment of definitions and charity legislation. There's a clearer SOFA presentation, especially related to impairment losses and disposal gains. And it's been the disclosure requirements have been streamlined. So the basic accounting model remains largely unchanged, but there's clarity within the SORP. There are no significant changes to provisions, contingencies, but the accounting and guidance has been extracted into a dedicated module within the SORP to make it easier to understand. The guidance on funding commitments is much clearer, helping charities distinguish between provisions, contingent liabilities, and non-recognised commitments. The SORP now is also containing more guidance on materiality. So it's helping decide when to disclose something, how much detail is needed, and when information can be omitted. In general, other than the 2 items that Steve and Brian are going to talk about, the leases and revenue recognition, it's very much been reorganised. A duplication has been removed and it's been aligned with the revised FRS 102 terminology. It's been rewritten in a plainer language to make it easier to understand. So that's been my gentle little introduction to the changes. I'm going to hand over to Steve now, who's going to go through the leases section, which is far more complicated than the bits I've had to do. Steve, thank you very much.
Thank you. Thank you for that introduction, Sam. Hello, I'm Steve Meredith from the Allianz division of Shaw Gibbs, and today I just wanted to cover off some of the slightly more complex bits around lease accounting. So what we're going to look at really is what's changing, how does it impact your charity, a bit of an illustration of what the old version is and what the new version is, how the numbers might be affected, the decisions and judgments you need to make now, and basically what you need to do to prepare for the changes. So what is changing? Well, as of today, if you have a lease, probably for a property, office, something like that, then at the moment it's not on the balance sheet. It's just an expense. It is expense through the SOFA, P&L, and that's it. But with the introduction of these new rules, then effectively you are putting something on the balance sheet as an asset, so-called right of use asset, a bit like a fixed asset, and also a lease obligation. So it does impact quite strongly on the balance sheet. So as Sam mentioned earlier, really, perhaps now is the time to think whether you can take advantage of receipts and payments accounts, because they're not affected. You don't have to sort of introduce this at all. So it only applies to those charities in the tiers, and the biggest impact really is the balance sheet. So if we look at what the current position is, you can see sort of clearly on the left really that no impact on the balance sheet, rent expense going through the SOFA. It's a charge against EBITDA, earnings before interest, tax, and depreciation and amortization, which is important if perhaps you have some commercial borrowings and the bank is looking at your results. And the same thing with gearing as well. That's if you have borrowings, etc., looking in relation to your equity tied up in the charity. But from the new reporting sort of period, the balance sheet will look quite different with this right of use asset and the lease obligation. And then the SOFA will have a depreciation and interest charge. So there's no separate line effectively for rent. And it does impact on your EBITDA in that you have a better result. Rent is normally expense, but if you don't have that rent in there, then your bottom line result will improve for EBITDA. But at the same time, your gearing may change, and therefore you have to just check your covenants with any loans, because it can sort of worsen as your equivalent of a debt-like liability is added. So that's really where it's going to sort of change. So if we go on to how it works, you create this right of use asset, and this effectively is added to the fixed asset sort of section, and will be depreciated over the life of the lease term, be it for rental property, or it could be for any form of other substantial sort of asset. On the other side, equal and matching will be the lease liability, and this is split between current and non-current. So it will impact your net current sort of asset position. And then over the course of time, it is unwound as interest is charged through the SOFR, the P&L. So that's basically how that sort of works. What is important to note is this all starts from day one of your new accounting period that is applying SORP 2026. So there's an asset and liability, and the two sort of match off. So if we go on to actually look on our next slide at how it might work for an office lease. So if you have a lease and you're paying the full amount, and say it's £100,000 a year for a 5-year sort of term, then what you have to do from accounting period starting from the 1st of January 2026 is quite different from how it looks at the moment. So at the moment, no impact on the balance sheet, as we mentioned, expense charged through the SOFR, 100 grand goes through. There's a lease commitment note, which will be appearing at the back of the account, showing the future obligations of 100 grand a year, and that's all you would do at the moment. But from the newer reporting sort of period, you've created a right of use asset and a lease liability. Now, the right of use asset is not simply 5 times £100,000, £500,000, because the rental payment or the cash payments you're making will be over the whole of the 5-year period, and you have to take into account the time value of money on the assumption that £100,000 in 3 years' time is, in terms of purchasing power, is worth less than £100,000 now. You therefore have to reduce the value of that. And so that's why we ended up with £435,000 here in terms of the asset sort of value, because it's discounted by what is regarded as your discounter rate, which applies within your sort of charity. So that's the balance sheet, and as you introduce the lease obligation, the asset and the liability match each other. Then over the course of time, so in year 1, you see there's a charge as the asset is written down over the 5-year period, the 87,000, and then the interest is charged on the liability. And if you move as we move on to this side, you can see that what's going on is there's a timing difference. So in the first column on the left-hand side, you can see under the current regime, it's a straightforward £100,000 being charged each year. But under the new regime, there's a difference in what is showing. Effectively, there's a front-loaded expense coming through. So there's a higher charge to the SOFR at the beginning than at the end. So year 1, £110,000 charge. Year 5, £89,000 charge. So it will look a bit different for charities as they get their head around this regime. And if we move on to the next slide, you can see here how it works in terms of the opening right of use asset and the lease liability and the impact coming through. So with the asset, you can see it being depreciated evenly, which is fine. But then on the liability side, on the right-hand side, you can see the interest charge flexes and gradually reduces as the cash payments, the £100,000 a year, are being made. Start off with the same position, and end up with the same position, but the balance sheet will look different in that the asset in years 1, 2, etc. will be lower than the value of the liability. So that's just something to bear in mind as we go through. Of course, that assumes we are using taking on board a new lease. as we move on to the next slide, we can see that actually where you already have the lease in place, you have to account for it. And with leases, you don't reopen the prior year. You just effectively assume at the beginning of the first year you are now using the new rules, you assume and take into account where you are in the stage of the lease. So in this example, we're 1 year in, and so we look at the opening position on the 1st of January 2026, and we have the right of use asset as the same amount as the closing liability, and then we work through the expense. So the interest depreciation is sort of charged through, come back to the nil position, but it is relatively straightforward in that you're not having to reopen the prior years, which is good. So that's how you would deal with a lease already in place. One of the other complications really can arise around dilapidations, and with the change to the SORP, one of the things you're expected to do is to look and consider whether you will have a dilapidation at the end of your lease term and what to do with it. And if it's quite clear, and there's a clause in your lease which says there's a dilapidation to pay when you return the property back, then you have to add that to the right of use asset and create an equivalent provision. And that's what's going on here. So same lease as before, expected £50,000 dilapidation. The time value of money means effectively it's £39,000 at the moment. So you put a provision in there equivalent to the right of use asset, and eventually the provision is increased to the £50,000 that you need, and the expense runs through the SOFA. So dilapidations are important and do need to be sort of taken on board as we go through. So really, there's a few judgments that you have to make, and probably now is the time to be thinking about it before you reach this financial year end. So look closely at break clauses, extension options, and really think, well, what are we going to do as a charity? Yes, we may have signed a 5-year lease, but effectively the landlord's indicated we could stay on for another 5 years. So, we don't really necessarily want to move after 5 years. So the likelihood is we probably will stay for 10, in which case that should be factored into when you do the calculations. Alternatively, you should be looking at dilapidations, and is there something in there or not in your lease? If it's silent, you could argue perhaps that there's no need to do anything. But if there's a clause that says you will repair and reinstate the property back to the state it was when we first took it on, then actually you need to put that provision in there for that dilapidations and get an estimate as to what it could be. Obviously, it's going to move, but you put a reasonable estimate in at this point in time. And then the other thing to bear in mind is rent reviews and increases. Quite often leases will have an automatic increase built in at certain stages, and that needs to be factored into the calculations. And you could end up with lease incentives. The landlord gives you 6 months off at the beginning, or when the next break clause arises, another 6 months off. That needs to be sort of built in as well, so you know what's going on and how the calculations will work. You can ignore service charges and non-lease items because they're expenses, they're sort of separate, and you incur them as you're going along because you don't really know what those are going to be if you're paying for cleaning or utilities or something like that. And of course, you add in the upfront costs relating to establishing the lease in the first place, probably legal fees and things like that, and that will be added in. So try to pull together that information as you're going along. But perhaps the biggest judgment we cover really on the next slide is this discount rate that you apply to your equivalent of what you need to use to account for the time value of money. And really the SORP says that there are 3 main ways of doing it. So rate implicit in the lease, unlikely to see that in a property lease, certainly, perhaps sometimes in a finance lease for equipment, you might see something. Your incremental borrowing rate. So if you were to borrow from the bank or you have something in place over a very similar sort of period, then actually you might have an indication as to what that rate may be. Alternatively, and it's probably going to be this last option that you will apply, is that you would be able to ask your bank, if you were to take a loan out for a similar amount of money over a certain period, ask them what you would actually sort of have to pay, and that would be one way of doing it. Of course, lots of charities don't borrow at all. They have assets, they have investments and things, and they tend to have a deposit account and generate income sort of that way. You can use the rate applied on your deposits, and that will probably be the simplest way to deal with it. So there are a few things to bear in mind that make life a little bit easier. Short-term leases, if it's less than 12 months, you don't need to worry, you don't need to put it on. Low-value assets, so things like computer equipment, you don't need to worry about those. So even if you're buying 100 laptops in one go, if they're all of relative low value, then you can ignore them and you don't need to put that onto the balance sheet. You can't for property or vehicles, minibuses and things like that. You can ignore nil and nominal consideration leases as well. So if you have a peppercorn rent and you've been sort of gifted something, effectively allowed access to a lease with a peppercorn rent, then that's fine. You can ignore that. So that's great. One of the things, though, that charities often end up with is social donation leases. So in other words, you are allowed a below market rent for your office space. And in that scenario, what you have to do is still account for the lease like any other lease, and you just need to go through the calculations. You may find when you're trying to work out what the value of your right of lease asset is, that actually there's probably two things which would influence it. One is the market value of the rental payments, and the other one may be the value to the charity. So in other words, if a landlord offered you a property which the landlord would normally let commercially for £100,000 a year, but offers it to you as a charity for £50,000 a year, but you as a charity would never pay £100,000 a year for that particular sort of premises. That's just not, it's too big or something like that, but actually it's a really nice premises. You would rather pay, the maximum you would pay is £60,000 a year. Then actually in terms of value to you, well, the market rate may be 100k, the value to you is only 60k. And therefore you will come up with an amount which is different from the lease liability. So the lease liability is based on the payments you're actually making. And when you compare your right of use asset with the lease liability, you end up with a balance, which is your social donation. And that's something that you need to recognise straight away as like a gifting kind through the SOFA. It can affect your opening reserves as well, depending on quite how it's sort of structured, but that's something to watch out for. So what do you need to do? How do you prepare for the changes? Firstly, get a complete list of all your leases, because you just need to be able to sort of account for them all. Note the key terms, start dates, break clauses, all those sorts of things. Actually sort of take a commercial view. How long we're going to stay here? How long do we expect to stay? Obviously it could well change, but you just need to know. There's a flowchart in the SORP which gives you an indication of how you might look out for the exemptions. You need to consider your discount rate and evidence you need to substantiate that discount rate if challenged by auditors, for example. And you then need to also give a bit of a heads up to your trustees or your main funders, other key stakeholders, to say, actually, our accounts are going to look a bit different sort of going forward. There'll be no comparative sort of changes. They're not restated, but from day one, we're going to have this unusual reserve sort of adjustment, and the balance sheet will look different. Then also you need to look closely at the social donation sort of leases that are already in place, because that could impact on your opening positions, because it could be a change of the deemed gifting income in the past. So those are the main areas to look out for, and I will hand over to Brian now. Thank you.
Thanks, Stephen. Yes, I'm Brian Clifford. I'm one of the partners here in the Sutton office. I'm going to walk through the income recognition changes. We've got a summary on the next page, which looks simple at first glance, but I'll highlight some of the areas where we've got some nuance and some decisions are going to need to be made here. So this should all be quite familiar to anybody that's seen the changes to FRS 102. The SORP changes broadly mirror those changes. Again, these will come in from the 1st of Jan 26. Key takeaways now, we're talking about a distinction between exchange and non-exchange transactions. So an exchange transaction is one where there's an economic benefit that flows in return for a delivery of a service or a good. Most simple point of view, you can imagine a cake sale. Very, very simple, perhaps a room hire. Also a very simple transaction. But that then becomes increasingly complex. Maybe that room hires a series of bookings. Maybe it includes a sports hall. Maybe there's some element of ad hoc coaching. Maybe it also allows you a discounted booking rate for the sports field or an additional discount to maybe watch the local team play. All of those little strands you can now picture might build into quite complicated contracts. Imagine delivering care for the local authority. You'll have different deliverables, different periods, all measured against different objectives that are somewhat related. Non-exchange income, it's income with no deliverables. Legacies, donations, grants without performance objectives. This should remain straightforward. The main consideration for a non-exchange income will be that it definitely doesn't have obligations that exist, and so that you are correctly allocating it to a non-exchange item. So as long as it is non-exchange, it will follow the old method of recognition, which we set out on the next tab here. So this is quite simple and recognisable. You measure the income, you recognise the whole amount when it's earned, and then so that's often either an immediate intro into the income expenditure account or maybe over a defined period that's set out in the contract. The new model, however, is more complicated. Now, actually, I think this model is quite a good primer for trustees, just to think again about the commercial arrangements. A lot of it does seem sensible, but as I wrote these slides, it gave me a bit of pause for thought at times. I think a lot of charities are going to run through their contracts when they look at this, and they'll see that there are some gaps maybe where their agreements are perhaps slightly unclear as to the scope of what's being delivered, or maybe just the pricing of individual elements within it. So if we just walk down this list, the identification of the contract should be straightforward. We should know our customers. We would hope some sort of contract is in place if we ignore the very, very simple transactions like prep bake sales at summer fetes. Point 2 does start to become a little more interesting. Does our contract actually help us identify these separate obligations? You'd hope that a good contract would, just from a commercial and business point of view. And if it doesn't, as trustees, that's maybe something I'll give some thought to, just to make sure the commercial and legal side is watertight, as we might hope. Point 3, the transaction price should be set in stone. I think you might see some quirks here where there's maybe some level of contingent income. Maybe if there are donated services or goods involved, it might get a little bit more complicated. But I think in most cases, this should be fine. Then our points 4 and 5 of allocating a transaction price and then recognising the revenue should be mathematical exercises, as long as we're comfortable with the first 3. But where we start to see gaps in terms of maybe the performance obligations or perhaps how values are attached to each strand of it, we start to get into estimates and accounting policies. And that is where the accounts and perhaps the related audit work and independent examination work is going to get a little bit more intricate. So if we move on to the next slide here, we'll just see what this looks like in practice. So I'm certain that everybody has got direct debits going through their banks like this. English Heritage, the RHS, Portsmouth Historic Dockyard, Peppa Pig World. These are all the ones I found at the weekend when I was finalising these notes. And lots of facilities have now got this style of membership. You have a price for the whole year, but there are a handful of ancillary benefits. Now, the old method, you would just recognise this over 12 months. £150 over 12, very, very simple. But now with the new model, if we just stay on the current slide for the moment, we just need to start to consider the additional benefits and separate the value. So you can start to see that the new model is more complex. You can imagine it being even more complexity here. Maybe it might also entitle you to discount the staff shop. Maybe you get a discounted rate for venue hire. You can see even a single membership might start to get intricate quite quickly. But for these purposes, we'll just take it at face value and then we'll walk through how this works. So on step 1 here, we know our contract. We know the subscription. We also know the contractual side is watertight and there are only these 3 benefits. And we're also, just for these illustrations, we're assuming that we've got readily available market data to price up the individual components. Again, you can start to see that if we didn't have data available for some of these perks, you may have to come, well, you will have to come up with a justifiable basis to allocate the income. But here we're assuming that we can put £110 of the entrance fee. We're also going to allow a wildlife day that would be priced at £40 for a walk up. And we've got a wildlife guide that we bundle in that's got a cover price of £10. As a slight aside, you can now imagine how charities are going to perhaps have more detailed accounting policies for income than in the past. And it depends exactly which framework they adopt, but there will be a significant level of estimation here that we will need to start disclosing both in the accounting policies and also those significant judgments that take place in the accounts. Point 4, because our points 1, 2 to 3 are relatively contractual, watertight, this is straightforward. We have £160 worth of benefit that we bundle into £150 worth of price. So we split the actual strand individually, so we get 15/16 effectively for each of the lines. The next slide, though, is where I start to find this interesting personally. So if we just start by taking the slide at face value, you can understand that the entrance fees, they'll allow you to come in for the whole year. So we spread that over 1/12. The wildlife day, that's a one-off. You either attend it, you don't attend it. Once that date has passed, there's no obligation on our part, so we can take the whole amount that's been paid into income. We've earned it. Same for the wildlife guide. There might be annually, there might be quarterly, but either way, once that magazine is sent, we have done our part and we can take that to income. But even just with this simple method, you can start to see that something that last year was spread straight line over 12 months now starts to become a bit lumpier and needs some more thought. In practice, if we start to see more sophisticated charities look a little more deeply at the data of what their customers use and start to allocate this income in a more specific way. I think we've all joined up for these memberships on holiday because the annual price is effectively the same as the daily price. We know full well we're not going back again. We're never reading the magazine, and we're certainly not coming back for a wildlife day. So I just wonder where this might go in practice. I think if I was an auditor and I was presented with detailed data by the client that justified that most members visited once, and the client then wanted to change their income recognition pattern to reflect that, would I have a problem with it? Probably wouldn't. Not if the audit testing checked out and the accounting policies were sufficiently detailed so the user understood how we're recognising the income. I think you could go about that either by changing the initial performance obligations. Perhaps what you may do is have a chunk of income for the initial visit. We're assuming here you take the membership out at the front door, you're coming in anyway. So maybe £90 out of that £150 is just you visiting on that first day, because that's what you would charge a walk-up non-member. And that what you then perhaps do is allocate a smaller amount to subsequent visits, because your data would support that people come back once or twice or 10 times. What does the graph look like? And then a smaller allocation again for the magazine and the wildlife day. It would depend on what your data supported. Do people engage with those other elements of what you're providing? The RHS has 600,000 members. If they allocated part of their annual membership to the Christmas day at Wisley, you're not getting 600,000 people through the door on that day. So I think the pricing and the split across these strands needs to reflect the commercial reality of how your customers are using your services. So mathematically, I think this new model is straightforward, but I just wonder what it will look like for the larger charities that have got really good data to understand how their users are using their services. Coming on to the accounts, if we move on to the next slide and just talk about what this looks like in a transitional year, pardon me. There's two routes. I, in practice, struggle to see that many people will go through a fully retrospective approach. I think restating the comparatives and also potentially the opening position on those comparatives is going to be a lot of work. I think I can see clients looking at perhaps where the changes really affect the covenants for any external lending. Maybe if it affects grant eligibility, because there will be some significant changes to the balance sheet and also EBITDA and the income statement in general. So I could imagine some charities looking at this a little closely and wondering if it might open or close doors if they go down one of these two routes. I could imagine perhaps if it pushed them in and out of different reporting tiers, be that the audit or independent examination, maybe into receipts and payments, maybe the different tiers of the level of disclosure that's needed. I could perhaps see some clients giving that some thought, but over time it should come out in the wash, because once we are fully adopted, these changes will come away. So I think the cumulative catch-up feels more likely. I can imagine for the users of the accounts, we may want to put additional disclosures in that are voluntary in this first year. Income, leases, fixed assets, deferred income, they're all going to look quite different. And so for trustees and for grant givers and just generally users of the accounts, I can see some benefit in having some disclosures in there that perhaps are non-statutory, but really help to make sure the accounts are true and fair and are usable. Probably wouldn't be dissimilar to the changes that came in when FRS 102, 105, 101 brought in. Those adjustments did change the opening balances, but here I could see a similar idea where we have some appendices or additional notes that explain how the accounts have changed compared to last year's. If we move on now into what we need to think about now, I completely take Sam's point about not letting reporting tail wag the dog, but if I was under a £500,000 worth of income, I have a tight budget and a finite amount of resource to look at these kind of areas. I could certainly see the temptation as a trustee to move into the receipts and payments bracket. Understand your revenue streams, absolutely, and I think that's both from a reporting and a commercial point of view, to understand how these changes will affect you, but also just to make sure that the contracts that you do have are fit for purpose. You sit there and think about the elements that build into that contract and how you're pricing them, and are you delivering what you would like to deliver. Same applies to the leases. Get that information together now. Simple leases will be fine to maintain on Excel, probably, if you've got a level of financial competence within the organisation. For larger books of leases, there are tools out there. If you use external tools, remember it doesn't remove your responsibility to provide accurate information. So just consider the competence of what you're paying for and who's who's preparing them. If you're subject to independent examination audit, there will be a lot of work on these balances in the first year. So it would be a fool's gambit to pay somebody to do it and to do it wrong and then pay the auditor to come and pick holes in it. As Stephen touched on, begin conversations with your stakeholders. These changes, especially if you think they're going to be material, they will have an impact on you. If you're dealing with external bodies, perhaps like the Arts Council, who are very, very particular in their criteria, understand how your figures will change and understand when your next funding cycle is, so when your real exposure is to these changes. And if you do feel exposed, start conversations now, be it with us, be it with those funders. All charities will need to go through this process, but depending on their leases and their income structures, you may be differently affected to your competitors. You may become less or more eligible for funding lines. Be clear which reporting tier you fall into. There are lots of resources out there. We can help you. We will be seeing a huge amount of these new style accounts and trustees reports, so do not be shy of asking for help. And absolutely, in summary, whatever you do, don't panic. Everybody will be in the same boat here. Pick up the phone, send an email. Shaw Gibbs and whoever your client contacts are, they will be here to help you. If I hand back to Sam now, I believe Sam's monitoring the chat, and we may be fortunate enough to have some questions. She'll have to unmute herself though, otherwise we won't get many questions at all.
Thank you, Brian. And Steve, of course, both very helpful insight, etc. So I have got just a couple of questions here that I was going to ask. So Steve, first of all, charity with several short-term property arrangements, how would you recommend this is approached, and how the SORP would determine, you know, which leases would be requiring recognition on the balance sheet?
Yes, it is back to, yes, to do your homework, look at the agreements, see what's going on, and whether they are something which are longer term. I mean, what I do see actually is quite often that charities have very short effectively licenses which tend to roll actually, rather than necessarily a long-term lease, and where perhaps a commercial building, the landlord can't rent it out at a commercial sort of rate for a decent sort of tenant, so they let the charity go in for a period of time, and they may want to give relatively short notice, so they only give a license almost on a monthly basis. Now, if that is the case, then actually they don't appear on the balance sheet at all. You don't sort of take them in. Obviously, if there is something there which is going to be for over a 12-month period, then you would have to do the exercise, do the calculation, and work out what that sort of cost is. But it is literally just digging through all those documents to actually really find out what type of obligation you have, and therefore how to record it. So yeah, it's do your homework now. Yes,
one by one. And Brian, going back to grants and things, so if a charity's got delivering services funded by multiple grants, possibly overlapping a little bit. How do you think it would be, what would be a good approach for them to take?
Yeah. I think you need to then get all of the, you're going to have to look at it as a whole initially. You're going to need to gather all of those income contracts and determine whether they're exchange, whether they're non-exchange. For the non-exchange ones, you should be fine. There should be very little change in the previous years. But then you need to maybe look at those ones that are exchange transactions and decide if any of them are relatively concurrent. Do they have very similar purposes? Were they entered into at a similar time with the same third party? So should you perhaps be looking at the whole lot in the round? If they are there sort of as a single commercial objective, then you should probably treat them as one contract, even though they might be under 3 or 4 different purchase orders. So I think that you've got a little bit of a mathematical exercise there to perhaps look at the data, but then step back to understand what you are supposed to be delivering for that third party. Would you enter any of those in isolation? Possibly not too dissimilar, frankly, to Shaw Gibbs engagement, where people will be just do the payroll in isolation, will be just do the accounts in isolation. This is actually a part of a wider remit where you then need to look at all of the individual strands and allocate the income streams properly as a bundle, as opposed to 4 or 5 individual transactions. But I think just because they're multiple grants that overlap in purpose, it doesn't mean that you should treat them completely separately.
Okay, that's good. Thank you. I've got one here that I will answer actually. So for charities that fluctuate year to year, how will the movement between the tiers work in practice? Now there's no, as there is with the company limits, you have to breach for 2 consecutive years. That doesn't happen with charities in this scenario. You know, that if you fall into the category tier 2, you're going to have to increase the amount of disclosure, etc. So if you're falling in and out, then you might well consider perhaps always adhering with tier 2. It would depend obviously on how stringent it is, how difficult it is to gather that information. But you will need to move from tier 1 to tier 2 if that's how your income is going to fall. A tier 1 charity may be required to provide a cash flow statement because it exceeds the company size limit. So you might continue to include something like that if you think you're falling in and out all the time. It may just be easier to continue on a consistent basis, I would have thought. Okay, let me see what else we've got here. Brian, back to you. How should a charity treat income when a funder pays significant amounts upfront for a multi-year project?
I don't particularly think the timing or the amounts should make an impact here. You still have that same process of what is being delivered. If they're paying a big lump upfront for a multi-year project, I would be very surprised if all of that was dependent on something happening in 3 years' time. But most commercial agreements would have stages throughout there of what needs to be delivered. If you're delivering education, it would be based on term times and a number of people in classes and the like. And so you would then recognise it as each of those stages are met. It'd be very, very strange commercially. Normally these things perhaps would have some sort of break clause each year if it's grant giving and you're not meeting the objectives within it. There may be clawbacks. It may just be that the first chunk comes in year 1 and you only get the second part if you've met the criteria for year 1, and that you've got a plan for what will happen in year 2. So I don't think just because you're getting a large amount up front, that's really any different to any of the other parts that we've covered, like a subscription or the like. It would go back to that general idea of what are you providing, what are the criteria for you to earn that money, and then it flows through at the point where you've actually met them.
Okay, that sounds good. And I've got another one for you, Steve. And you did go through this, I think, but it would be a good reminder, I think. What are the exemptions available for smaller charities, and when would it be appropriate to apply them? Related to leasing, obviously.
Oh, right. Okay. Yeah, fine. So really, it's down to sort of how short, short they are fundamentally. So less than sort of 12 months. So if you're coming to the end of your lease at the moment and it's less than 12 months left, then actually you wouldn't bother sort of putting it on at all. And then there are certain around sort of assets and equipment for those smaller value items. Now, it does actually raise a point. So, I mentioned about sort of laptops, and you can have 100 laptops, and if they're all £400 each or something, then you wouldn't put it on the balance sheet at all. But there's nothing in the FRS 102 itself and the SORP to indicate what that level is. What level do you use? There's something in international financial reporting which gives an indication of $500, but probably what you might want to do is think what your capitalization level is within the charity at the moment. So if you capitalize items above a certain amount, like £500, for example, that's probably the level you should be thinking of. So it's probably a good time to think about sort of capitalization sort of levels at the moment, because that will probably give you an indicator as to what you can include or exclude. Obviously, for those bigger items, so for example, the school charities and things where there's many buses, then you have no choice. You just have to sort of put them on. But for most charities, it's just keeping an eye on what you're entering into, really, and taking it from there. Actually, one of the questions that I also was raised with me was around leasing and properties. Is I'm aware that we have a number of charities where they are the landlord, and how do you reflect that as the landlord? Does the SORP change to the SORP impact on them? And basically answer is no. So we have got one or two charities where they are the landlord and the tenant. So they have one operation which the landlord lets them use the premises, and the tenant sort of takes on those premises, and that's an associated or a subsidiary sort of charity or sort of company. There'll be different reporting regimes sort of going on there, so there's a bit of complexity around it, but fundamentally it doesn't change for the landlord as to how they sort of recognise that. If you are a charitable landlord, the way you reflect that has not sort of changed. So there is a bit of complexity, particularly where you have charitable groups, where you have trading entities, as well as the charity itself. And if you are letting a premises to your trading entity, the trading entity will, when they're doing their lease calculation and putting that onto their balance sheet, they were probably using a different discount rate than perhaps the charity, because the charity could be using the 5% rate around its deposit rate, whereas the trading entity would have to use a equivalent of a borrowing rate, which could be much higher than 5%. So yes, there's definitely some sort of some funnies which go on where you have the larger charities which have got trading entities sort of linked in within the greater group, and I can see that's going to be one of the main sort of areas of difficulty for people to get their head around. When you consolidate it all sort of disappears, but there is a complication as we go through. So that's one question I was asked.
Okay, thank you. I've got another question on the tiers. So income sitting above the £500,000 threshold, what practical changes should we expect when transitioning from tier 1 to tier 2? So I guess what you're going to need to do, you're going to need to monitor your income quite closely, so that you know when you go over that threshold, and be aware of the increased disclosure that's going to be required when you move into tier 2, so that in that build up you have in place information that you can collect on the way, so that you're not trying to do it in hindsight. I guess you're not trying to, you don't get to the end of your year, realize you've got to tier 2, and then you've got to go back and try and work out, you know, how many hours your volunteers have spent and all the individual roles they're doing. So just be aware of it, so that you're planning ready for those increased disclosures as you approach the next tier, so that you're ready for it. That would be my indication there. I think that's about it. So unless anybody else very quickly wants to add a question into the chat, Steve and Brian, have you got one last word of wisdom you'd like to say?
I suppose from my side, it's just literally prepare now. Sort of do the homework, do the documentation, work out where you sort of sit. It's complex for everyone, but I think doing it at the beginning rather than the end, I think that will be really useful.
Great. Oh, actually, I've just had another little question pop up here. What if one grant is supporting multiple projects? I think that's probably to do with income then.
Yeah, Elaine has also
Brian.
got that in the Q&A. I just answered it in the Q&A, but I think you've got one grant. That's not useful for everybody. I think if you've got one grant that supports multiple projects, I think it's not quite the same, but it'd be similar to the membership idea. That grant, if you have a £10,000 grant and you are delivering whatever, you're delivering some walking football, but you're also delivering some sessions in school, and you are giving away some free tickets to local groups or whatever else. It may not say within that grant exactly how that income is split across those, but you'll have a decent idea yourself commercially what it's going to cost you and the effort that it will take to deliver each of those strands. You will know that each element within that project is going to have different goals within it. And so I think I would come back to that idea where you're going to take your best estimate of how to split the income side, and either the project or frankly the part that you're working with will know when you have delivered what they wanted you to deliver on the back of that grant. So I think you will not have a perfect solution, and it might be one that if you did it again next year, you might change how you allocate them because you've got a better idea of what actually happened. You won't be criticised as long as you can show your workings, I think, to an extent, and it will be, we are here to help you with that. I think that would be my general idea. There is going to be an element of estimation. You'll document that. You'll probably have that perhaps in the accounting policies and the like. If it's super material, then get us involved now. But I think there will be sensible solutions to these.
Great. And actually, there is in the chat, Steve, there is another question on leases.
Yeah, I've just seen that. Yeah.
Oh, sorry.
Yeah, that's fine. So in the case where the lease is subject to a RPI uplift, yes, you will do the calculation, but you will actually have to review it sort of each year just to sort of to make sure you've got things right, because obviously if there's a material sort of difference and variance sort of coming through, then you would adjust for it. But yes, you make your sort of best assumption as with the provision for dilapidations. You just have to make a best assumption when you start, and just keep an eye on it to make sure if you need to really change your figures. Hopefully it's within the realms of materiality, that it's not too far out, but that's the best approach, I think.
Okay, that's great. I think we're just about at time. So thank you very much, Steve, and thank you very much, Brian, for joining us today. Thank you for everybody that attended. As I said earlier, we will send out a recording of this, and of course we're all here to help if you have any questions. Thank you very much. Goodbye.
Thank you. Bye-bye.